Inflation remained at low levels in November 2014. Annual headline inflation rose slightly to 2.1% from 1.8% in October, driven by a small rise in food crops inflation, while annual core inflation declined marginally to 2.3% in November 2014 from 2.4% in October 2014. The current low rates of inflation are partly attributable to a fall in food prices in 2014 due to a good domestic harvest, lower global food prices, and subdued traded goods price inflation, partly driven by the decline in crude oil prices. The Bank of Uganda's medium-term macroeconomic forecast remains unchanged since the last Monetary Policy Committee meeting in October 2014. Over the next 3 months, annual core inflation is forecast to be in the range of 2% to 4%, before rising to about 5% over the next 12 months, which is in line with Bank of Uganda's medium-term inflation target. Core inflation is expected to rise because of the increased domestic demand over the forecast period and also the pass-through effects of the nominal depreciation of the exchange rate to domestic prices, which is not yet complete. However, Bank of Uganda recognizes that there are still upside risks to inflation over the medium term, which include the risk that domestic demand may be stronger than is currently forecast. In addition, there may be further exchange rate depreciation pressures, and food prices may rise by more than expected if harvests are poor next year. Real GDP is projected to grow by 5% to 5.5% in 2014-2015, compared to an average estimate of 4.5% in the previous year, as indicated in the rebased GDP series recently released by the Uganda Bureau of Statistics. Growth will be supported by higher public and private investment and a recovery of domestic demand. However, the weaknesses in the global economy could undermine growth prospects in Uganda, in particular through their impact on demand for Uganda's exports and inward flows of foreign direct investment. The Bank of Uganda's macroeconomic forecasts indicate that core inflation and real GDP will tend close to their targets over the medium term. Bank of Uganda's macroeconomic forecasts indicate that core inflation and real GDP will trend close to their targets over the medium term. As such, the Bank of Uganda has decided to maintain the central bank rate at 11% until the next MPC meeting, which is scheduled for February 2015. The band on the CBR remains unchanged at plus or minus 2 percentage points, and the margin on the rediscount rate is unchanged at 3 percentage points on CBR. Consequently, the rediscount rate and the bank rate will remain at 14% and 15% respectively. That ends the monetary policy statement.